Imagine stepping into a new home, the smell of fresh paint filling the air, and realizing that the financial path to this dream was paved by someone else's footsteps. This is the reality when you assume an existing mortgage. The concept of assuming a mortgage is a fascinating one. It means taking over the previous owner's home loan under the same terms they had, including the interest rate and remaining balance. This can be a game changer, especially in a market where interest rates have climbed since the original mortgage was taken out. Essentially, you're not starting from scratch with a new loan, you're stepping into the shoes of the current homeowner. Not all mortgages are assumable, though. Government backed loans like VA, FHA, and USDA loans are typically assumable, while most conventional loans are not. The key is to check with the lender about the specific terms of the mortgage before moving forward. Let's paint a picture with a practical example. Imagine Sarah, a first-time homebuyer who finds an idyllic suburban home. It's perfect, complete with a white picket fence and a beautiful garden. She learns that the sellers are moving overseas. They bought the house 5 years ago with an FHA loan at a 3% interest rate. Right now, the market rate is around 6%. Sarah has the option to assume their mortgage. By doing so, she gets that original 3% rate, saving thousands of dollars over the life of the loan. Plus, she avoids many of the costs associated with originating a new mortgage. Sarah does need to come up with the cash to cover the equity the sellers have built in the home, or she'll have to find a secondary method to finance that portion. However, the immediate and long-term savings from the lower interest rate make this deal incredibly appealing. Now, let's dive into some reflections on why assuming a mortgage might be a smart move. First, it's a rare opportunity to take advantage of favorable loan terms that someone else locked in during a better rate environment. This can be especially beneficial if interest rates have risen significantly since the original loan was issued. Second, by assuming a mortgage, you might be able to bypass some of the approvals and fees that come with a new loan, though you'll still need to qualify with the lender according to their criteria. There are, of course, important considerations. You still need to negotiate with the seller and potentially pay for the home's equity. But if the stars align, assuming an existing mortgage can be a strategic move that offers stability and savings. In the end, assuming a mortgage isn't just about stepping into a house. It's about stepping into a financial opportunity. As you consider your next move, keep this option in your toolkit. Thanks for watching, and please subscribe to our channel for more real estate tips.